Welcome back to the best prop for you. And we are going to talk about US oil today. The WTI was near a 5-week low earlier in the session on hopes that the US and Iran were finalizing a framework to extend the ceasefire by 2 months. The deal supposedly included Washington easing blockades and Tehran reopening the Strait of Hormuz. But those hopes just collapsed, as you can see. A big rejection down below the 90 level. The US launched military strikes in southern Iran, claiming they targeted boats attempting to lay mines and missile launch sites. Iran declared the 7-week ceasefires are broken, and as a result, of course, crude oil just spiked to, let's just be a little bit more consistent here, from a low of around 99.40 all the way up to 93.80, which is around 5%. So that's on an intraday basis. With the situation remaining highly liquid, of course, and Trump pushing for expanded Abraham Accords, further escalation could easily send oil prices soaring again. But the question is, what do the charts say? Does it align or not? Well, looking at the daily chart, the structure still resembles a kind of long-term symmetrical triangle. The recent drop could simply mean that the triangle ended around 89. Okay, or we could drop all the way down to 79 actually and still remain within the triangle pattern. Why? I will show you now. Typically, triangles revolve or resolve. Well, you see, we didn't get actually new low here. So it could be a case where we ended. But it might also be a case where we move lower, and this is a short opportunity. But for now, because that is the low and not this, we could have ended. The issue with that is that the wick connects in A, but we on the C wave we connect the close of the price, which isn't typically ideal, but it looks more symmetrical than if we connected the two bottoms over here. Okay, but even if we do drop to 85 or around 81.60, 82 level, which is of course a potential buy zone, then that aligns perfectly still with the, like, say 80% dip. Okay, 78.6, which typically is where we see waves ending. However, I want to tell you that typically E waves, the last wave of a triangle, ends up truncated to the 61.8. So my thinking might be that this can be considered as a double bottom, okay, and a false break here. In theory, in practice, that is wave E. But even if we use that pricing, we're still looking at the same price levels pretty much. 61.8 has actually worked out fairly well. The only difference between these two is the structure going up. That looks corrective, which means even if we do go higher, we'll have a hard time crossing effectively above the 103, or let's call it the upper trend line of the triangle, potential triangle. Unless if, of course, we see this creating a 5-wave leg to the upside, which would be showing us, suggesting a bullish price action. So this is important context to keep in mind. I, for one, look at the rejection at the bottom of the Bollinger Band, the flatness of the median band, and also the fact that we have actually a gap from 96.88 down, which seems to be a case where this has got good chances of closing, at least the gap, which means good chances also to revisit the 100, triple digits. Now let's go down on the 4-hour and see what does this tell us. Is there anything more what we can use to our advantage? Well, as I said before, it does look like we had a double bottom down here. This is a buy zone, okay? The bottom of the Bollinger Band is flattening at the same time where the RSI reached an oversold level, and we are very close to the median line, which, by the way, comes exactly at the 50 Fibonacci retracement at 95. So break that and off we go towards the 100 level plus, perhaps. Okay. Now, we haven't also reached the 50 line. So I see potential here to go and break that resistance. But I want to tell you that 96 probably is going to be a very strong resistance to break. So we could expect a potential pullback. And then we decide whether that's leading to potential upside, whether it suggests, it signals upside or further downside. Both are possible. Down the 1 hour is going to show us actually something else, however. If we look a little bit closer, I am seeing a potential inverse head and shoulders. You've got the left shoulder, the head, the right shoulder, and off we go higher. Typically, what happens is that the distance from the head to the neckline, the measured move, from the breakout level, which is here, is where we can expect prices to go. That opens the door to 96 plus. Okay, and it indicates, it suggests that we could essentially break to higher levels even on the 1 hour chart. There is very strong resistance at 98, but also let's not forget this is 97 and the bottom here at 96.20 is the bottom of this opening gap, right? So this territory here is going to be an important support, it's an important resistance level. Okay, so for now, which falls within this head extension of the right and of the inverse head and shoulders. Now the bands were flattening and now they are kind of expanding. The RSI hasn't yet reached 70. We did have a bullish divergence also between the left shoulder and the head. So this screams to me there is potential for further upside. But in the very short term, we need to maintain 90 to 80. Even if we tag that level, the potential of going all the way back down to 90 and perhaps lower is going to increase once again. So if this pattern plays out, we could see a quick peak around the 96 resistance level, which is a major previous support, as I said before. We also have that divergence that pushes for that. So I will be watching for price to extend towards that level. If it hits it, then acts probably as a resistance where aggressive trades might look for a short-term scalp short. Scalp short until we see what is coming up next. But the bigger play is to wait for the pullback from 96 down to, well, let's say 93, 92, and grab a long position with a target at the psychological 100 level. So trade safe and keep an eye on the headlines.